Ron, happy Monday. How you doing?
Hey, I'm good, Ryan. How are you?
Good. I'm super pumped for this conversation. We got introduced by Rob Dubé, who is a mutual friend of ours. He's been on the show. He quote unquote said, "If you want to meet a sales machine, you got to meet Ron." So no expectations here, but
Yeah,
after hearing your background, I'm super pumped because, like, just even on our conversation, it was a lot of fun. And literally, since you and I talked last, you guys bought a company.
we did. Yeah, we did. That was in the works. I couldn't really talk about it when you and I did our kind of pre-show game plan, but yeah, it's been announced officially, so we're really excited about that.
So I'll just kind of maybe set the stage for a couple seconds, and then I want to you can kind of give a background because Ron, you and I had this whole conversation about how intentional you guys were from the beginning, how you've grown and you've gone through multiple transactions. So we're going to unpack this, but before we go through the whole story, why don't you just give everybody the Cliff Note version of what do you do, how did you get to where you're at, give some context, and then we can unpack it.
Sure. Yeah. So I'm president and CEO of Service Express, which is based in Grand Rapids, Michigan, and has over 50 locations across the U.S. And now, as of about a week or so ago, we are international with an office just north of London based on a recent acquisition. And Service Express is a third party maintenance provider. So we talk about the TPM space of we sell service contracts to fix servers, storage, and networking gear inside large corporate data centers.
And you guys have, I don't know how many employees you guys or what numbers you got that you're comfortable with of maybe Ron just kind of setting the context of whatever numbers you're comfortable sharing of where you started and where you are today, because it'll give some solid excitement to understand how the heck you got to where you are.
Yeah, no, no problem at all. So when I started back in 1997, we finished 1997 at 2.8 million, 4 locations, and about 20 employees. And so currently, we will finish in 2021 at roughly 240 million, 800 employees, and 50 plus locations in the US and now in the UK as well.
And like Rob Dubé said, you're one heck of a salesperson. So we're going to talk about how the heck you did that. So why don't you just walk us back, in the 90s, how did you get to the current position you were at when you were in the 2 million mark? Because when you told me your background, it was very intriguing to me. It was not, you didn't get spit out as some like raging salesperson. You had a different path that brought you to where you're at.
Yeah, I think pretty non-traditional path. So I graduated from Central Michigan, which is based here in mid Michigan in 1992. I had a teaching degree. So when I started college, I thought I was wanted to teach and coach. I wasn't that much of a student, wasn't that into school, but knew I wanted to go to college and figured, well, I'll teach and coach. That's something I enjoy, and that's maybe what I'll do. So when I got out of school, I no longer wanted to do that for a couple of reasons. One, I kind of realized one of the things about teaching that I didn't really like was that you had to go back to school, which I didn't really enjoy school that much in the first place. And so what you were going to make, your compensation was laid out for your whole career based on continuous education and number of years you taught, nothing on performance. And I was like, I don't think I like that. If I'm a better teacher than you, I should be paid a lot more. And if you're better than me, you should be paid more. And so that didn't really sit well. And, I think you grow and, I don't know if you mature is the right word, but you just grow and evolve as a young adult between 18 and 22. And I had some friends from Central that had graduated and were getting sales jobs. And the way they would describe it and the way I would kind of watch and see what they're doing just really resonated with me more at that time. So I decided I didn't want to teach, and I came out and wanted to build a career in sales. And, now like Central has a great sales program. So does Western Michigan. That's an hour down the road. So you can get a degree, you can major in sales. Well, there was none of that I knew of back in the early 90s. Business was either marketing or accounting and finance. It was not sales, right? And so it's like, you got to get sales experience. Well, how do you do it? You got to find a sales job, doing something. So my first job out of college was selling health club memberships for $6 an hour, plus a little bit of commission, So I'm sure I made my parents so proud with that. But, I did that for like a year and really got the sales bug, really enjoyed finding out what was important to people, walking them through the health club, and then, signing them up for a membership. And just that juice of getting a signed deal started to resonate. And, but I knew I wanted to get in outside sales. I was really searching, And I tend to search, by the way, Ryan, which means I take action and then I figure out if I like it or not. I don't do a lot of research up front. Obviously, with my so-called teaching career, that was all laid out before I went for a teaching career. I just didn't pay any attention to it. So I just jumped in. And so on that note, I was like, man, I really kind of want to be my own boss and I get a real estate, license and sell houses. So I did that, sold a house, and but then realized, man, I'm working all nights and weekends while my buddies are all hanging out. I'm sitting in an open house or showing houses, and this isn't what I want to do. So I stopped doing that. I got an outside sales job selling long distance services. This was a thing in the early 90s where there were resellers that would sell, like, I don't exactly remember how it worked, but they would like buy lines from MCI, AT&T, Sprint, and you could resell long distance services at a reduced rate, business to business. So I would do face-to-face code calls. Now everybody picks up the phone or through LinkedIn. I'd go in a business park and go go in and
pick up the cards, right?
Pick up the card. If you got in, they trained you. They really did great training, like a one-call close, like 7 steps to the sale, all in one call. And so I got great training. The job was pretty horrible. It was pretty tough, but man, I developed thick skin. I got the training. Again, I learned a lot through that. But then I was like, I need a change. So I quit that job and I moved to Nashville, Tennessee with a good buddy of mine from high school who was like the exact opposite of me, researched everything and had a job lined up right out of college and went there. And I quit my job and moved down, and with no job. He's like, what are you going to do? I'm like, I don't know. I'll find a job down here. You can always get a sales job.
Isn't that the truth? You can always get a sales job, work for nothing, and that's all on performance.
Yeah, exactly. So I did that. I ended up finding a great job with a great little company down there. And I did that for 3.5 years before I moved back, joined Service Express. I moved back to, the story, met a girl, came back, got married, and ended up joining Service Express, coming in as a sales manager for them. So it was my first leadership position that I had with Service Express.
And so give us a little bit of a backdrop so that, because you didn't found the business, but when you were telling me on our previous call, like, interesting owner mindset, because that owner kind of let you run with it, versus you and I chat a little bit about how egos get involved with owners as they're thinking long term. And I based on what you were saying, the foresight with the owner was very, I'd say, evolved based on what I've seen. So kind of walk us through, like, what was the setup, and then what was your duties, and like, how did you grow the business right off the bat?
Yeah, so I came in as a sales manager, and he hired me to do that, and said, I want you to drive all the revenue activities, and he would take care of service delivery and support and operations on the back end. So that's what I focused on. And I brought the training I got at the long distance company, the 7 steps to the sale. I brought that right here. We didn't do it all in one call, but really spread it out. And I think did it a little bit more professionally. I took the cold calling techniques, but we would set appointments on the phone by that point, the sales training. I took a little bit from every job that I had, which was really cool looking back. Managing multiple locations, I took from the company I worked at, contract sales managers in Tennessee, and proposals from a company that I supported in Tennessee, Tanner Corporate Services, put together a standard proposal. And so did all that, standardized everything, brought in training and taught the team. And it just started to take off from there. And so we had a good run for initial couple of years. I got into some trouble when I tried to start hiring for the first time.
What do you mean by trouble?
I was selected wrong. I was really bad at it, and people will tell you like, oh, I have an instinct for hiring, and nobody has an instinct for hiring. It's really hard to do. I learned a skill and a process to go through, which helped me make better decisions. And I learned it, like a lot of things, the hard way. And so I stumbled there for a little bit, but got that straightened out, really started to focus on culture and people and building relationships. Again, I kind of did that wrong at the beginning. I was too intense, too driven, too numbers focused, and didn't lead with connecting with the right people. I didn't hire right. I wasn't connecting right, and really just stumbling for a little bit. First couple of years went great. Second couple of years stumbled, and then we came out on fire again. Got some things figured out. Company was growing, and just got to a point. So this would be like 2002. So I'd been there 5 years. The founder really taught me the business, and really taught me not only the industry, but more about finance, the service side, the operations side, and everything. And we're going through some growing pains. When you're a growing company, there's always growing pains. I mean, we still go through some. You're always getting bigger and trying to figure things out. And part of that was I think him and I talking about his strengths and what he really enjoyed was the startup part of it, like to kind of making something almost from nothing, risking a lot and making it happen. And he was great at that. And I mean, he really took it from nothing to where when he brought me on and helped me grow it. Where I think as we started to grow, where I really liked was scaling it, which would be systems and strategies, right? Around training, around all things in the business. And so him and I talked through that. And I just might, I was like, hey, I think you should name me president, and just be investor and let me run the company. And he said, all right, well, if you want to be president, why don't you go out and act like you're the president? See what you do. And so I did. It was kind of funny because we still promote this way to some degree. Like after we talked, I went out. I didn't get the job as president, get the title. I didn't get any compensation increase, but I got permission, and he gave me the opportunity to see if I could go behave like a president, which was at the time and still is. Anytime this, I encourage new leaders, which was to come alongside other leaders and say, "How can I help? What are you doing? What's in your way? How do we communicate, work together, get everybody on the same page?" I mean, communication and run around talking to everybody and getting everybody on the same page, I think, is a strength of mine. And so I did that for about 90 days, and it was going pretty well. So he just said, "Hey, I think I'm ready to do this. Let's make this permanent." And so we did in 2002. And yeah, I mean, it's an amazing move. I've really never seen another founder do that. That he would trust me at the time, and he packed up his office, left the company, left all day-to-day responsibilities, never came back in an operational standpoint. I would bounce ideas off of him, communicate with him. He'd come in when I wanted to talk with him, but he really just said, "Go to Ron," and he let me do it, and he let me figure it out and let me do it my way, which was probably different than his way, but he let me do it. And I just think it's one of the greatest. I think it's one of the greatest moves of like a young business owner has done, and it worked out well.
Super interesting. This is where, like, because I think it lends the data point, Ron, to how you guys got where you are. And what I think is interesting, I'm curious to hear more about, and I think the listeners will benefit of, like, why was that a thing? Like, so like when I hear those kind of stories, I go, well, either the owner understood about valuations and value growth because there was some bigger picture in mind that allowed them to put their ego aside or whatever it is, or for some reason they hated the more mature business so bad that their hate for the operations allowed them to get out. But I'm just curious, like, what was the catalyst to actually make that thing happen?
Yeah, I think a little bit. He didn't hate it. I just think didn't really give him energy that he wanted to be in it all the time. But he didn't hate it. I mean, he loved it. He loved seeing people take advantage of the opportunity. He really built it and wanted people to take advantage of it and do that. But we were always. I think that was a mindset that, and he probably would have sold a lot sooner if I wasn't telling him, like, "Hey, I'm not ready, don't sell it, just keep being my investor," um, to do that. But he really had that built to sell mindset. I remember when we were working together, and he had all of us, he had me and some other leaders listen to Michael Gerber. Do you know Michael Gerber, the
For
email?
sure. Yeah,
Yeah.
absolutely.
So he really got that concept, the entrepreneurial myth, which was, it's not about the owner doing everything. You've got to create the system, the processes, and let other people do that. And so I think it was a balance. And I think he saw, maybe potential in me that I could run this and do it. And he knew that's what I wanted to do. And he was really passionate about giving opportunities to other people. And that's where it grown to and what the opportunity looked like. And yeah. And, fortunately it did well. Like we had to do well. We wouldn't be talking if it didn't,
Right.
if it didn't go well, but
It'd be a different story, but
yeah, but nothing was guaranteed. He didn't know it was going to go well. He really took that chance. And he had all the financial risk. Him and his partner had all the financial risk. And so I always just still look back and marvel at that.
So, this is in 2002 as you're kind of going off now and you're taking to the next level. And you say you're talking about how you're passionate about scaling. And so from our conversations, you talked about like the fact that you almost took it to market once and then you ended up doing it again. So the reason I'm kind of expediting this compared to most stories is because you've done this multiple times. So we want to kind of get into this, to the nuts and bolts of it. But I'm also curious, like, what triggered it to like allow you guys to start accepting different offers, and like, where was that in the timeline?
Yeah. So, 2002 started growing at double-digit growth every year. That was always our goal and objective. And in fact, in 2002, I formed my executive team with my chief operating officer, my CFO, and my chief revenue officer at the time. There's four of us. And we came up with a BHAG, Jim Collins BHAG, big, hairy, audacious goal, right? And we said we want to be 100 million in revenue by 2020. I mean, people looked at us like we were stupid and crazy. Like 100 million, we were like 7 million at the time. But we're like, no, if we do double digits, we kind of did the math, like we can get there. And that's our BHAG. And a BHAG is supposed to make you nervous. And a BHAG is supposed to, make you, it's not a projection. It's I have no idea how we're going to get there, but that's what we should be thinking about. And that will help us think about the scale that we need and the systems and processes and everything that we need. So, one advice I always give when people are asking about, wanting to be part of a growing company or wanting to scale their companies is to think about what's the goal and does everybody have a shared goal? Because too often people will tell me that, then I'll talk with them about, hey, this is what I always ask. If I took you all in separate rooms and asked you what your revenue goal was in what time, I think I did this with Rob maybe, and just like, would I get the same answer back from every one of you? And I get this look, and I think Rob did it pretty well. I think they did have that conversation and, had come with that, but other people I've talked with about that. And so what you realize is they wouldn't. Everybody kind of has their own different ideas. So I think one key thing I would say is agree on a shared goal, a BHAG in our case, and that you're aligned to and driving to, because if not, then you pull in different directions. So we set off towards that double digits every year through the financial crisis, going across. Again, the founder always said he will exit. He was building it to sell it. He thought it was going to be like 5 years. I kept talking him into like, no, stay. This is going good.
I'm having a lot of fun.
We're doing good. And I'm just not ready for private equity and all those things yet. So 2014, and we'd been approached, and I talked to investment bankers, some private equity, just trying to learn the whole game. We got approached by a firm, came in, said all the right things, put a pretty nice number out there, a bigger number than we'd heard. And I said, well, I have to take this to the owners, and we talked through it and said, I think this is worth pursuing. And so we just said like, hey, as long as this is straight up, we're Midwest guys, we're really not for sale, but if this is straight up, this would be interesting. I think we could maybe do something. And so we signed an LOI. We didn't have a banker, which was my first mistake because I was caught in the middle trying to negotiate everything and between the founders and the private equity group. And I didn't know what I was doing. And long story short, that did not go well. There was a retrade on that. It was kind of like the negative stories you hear around private equity I experienced, right? The retrade, they find everything wrong. The prices got
define retrade for the listeners who might not be familiar.
They give you a number, and then a month later, like, well, after further review, it's actually, 20% or whatever the number was less than that. And you're like, what? Like, well, yeah, because of this. And so
according to our internal rate of return that we had to begin with, we can't pay this much.
Yeah. So that was the first, and we tried to work around that. And it was, well, okay, we talked ourselves in. It's still a good number, but basically, the longer we talked, the terms got worse, every step of the way. And so at the end of the day, we ended up walking away from that deal. But it was a great learning experience, as it was tough, but it was a great learning experience. And what we all learned was, as we regrouped, was we're ready to go to private equity. I was ready. The executive team was ready. The founders were ready. And we learned and said, hey, let's for where we're at, let's hire an investment banker. Let's run a process and kind of do this right. So in 2015, we interviewed investment bankers, selected one, and went through a regular sort of formal private equity process where we, put together a packet, the whole deal, and went out. The bankers walked us through, and we ended up selecting a firm in July of 2015.
And so which is super helpful for the context, Ron. And I mean that because I think there's so many different parts of this that we can go dive into to highlight some of the really interesting things that you learned along the way. Because you've also sold it again to private equity, and I want to unpack that. But before we do, this first experience that you had, I'm curious. You and I talked a lot on our previous call about mindset and the shifting of people's mindset away from the kind of the vanity metrics of revenue, employees, and gross profit to value and valuations. And there's this whole other game over here that, your revenue's jumped up quite a bit since the last time we talked because you bought a company, right? And so I'm curious, when you had this $100 million BHAG in line, that was revenue, and you went through this whole process of learning through experiencing, trying to take it to the market at that beginning, what shifted your mindset, or how did that happen as you started to understand value, and what got you to the point where where you said to your team, we are ready for this. It's just not this one. So what did you learn throughout that process that got you ready?
I think we were kind of learning along the way, knowing that in order to get the highest valuation, which is normally a certain number of, like, taking your profit, right, times whatever the number might be, 5, 10, whatever it is, right? And so I think what we learned along the way, even prior to that, was having repeatable processes and systems, not having customer concentration, not having location concentration, all these different things, because, right, anybody who's going to invest in you is going to look at the downside of anything that's out there. And
Did you
so,
guys know that ahead of time though, Ron? Like, you can, because you've gone through it enough. I'm just curious, like what maybe what I'm trying to bubble to the top is you speak about so much like this fluidity, and I do the same thing on this show, right? We talk about multiples of EBITDA and deal structures, and you start to realize like, where did I start to learn these things? And then how did my behaviors change because of what I learned?
couple of things. One, we read the book Built to Sell, and you know the book?
John Willow's been on the show a couple
Yeah.
times.
Okay, yeah, yeah. So great book, right? He lays it out there completely on that. And then reading Inc. magazine, Norm Brodsky wrote a monthly article, and I don't know if you know Norm or not,
He's been
but
on the show too.
been on there too, right? Yeah. And so he really detailed the experience that he had. I think one where he walked away and one where he sold it. So
Well, it's so interesting, Ron. You said the $100 million mark, and I was actually thinking of Norm's interview where he said, "I want to be $100 million," and he went broke trying to get to 100 million. And then the next time around, he was 25 million in revenue and at $10 million in EBITDA, and he sold it for 120 million.
Yeah, yeah, right. So really interesting. So we just learned that, and I think again that that's part of the fun of being here. You're trying to figure out and learn all that stuff for perspective. So we are always doing work, calling, again, what Michael Gerber would say, working on the business, not just in it. So we're always thinking around how do we add value and what would create the most value in learning. So I think we caught on to these things, and Norm says it in, through his series, and I think Warlow does too. Like, building your business to sell is a great way to run and build your business. And Michael Gerber does. He says your business is for sale every year. You're either selling to somebody or you're deciding to buy it yourself. Meaning every year you keep it, you've just bought your business. So what are the things that you need to do to make it the most valuable business you could be? And it was, so Gerber talks about that, entrepreneur with a technician mindset, where they're just in the business, working hard all day, but not thinking about these scalable systems and processes. So again, the founder introduced that and got that concept early, showed it to us. We all bought into it, and then realized this is a great way to run your business. You should always be built that way.
And we can get back up to the present of where you're at in your story, but like, I'm curious, like, you mentioned that you were stuck in the middle between the buyer and the seller, and like, I can kind of relate a different situation because it was my dad, but I was in the exact same position as the overall structure as your situation. How did you deal with it? Were you and your owner? Because that's complicated when you're trying to also paint your own path with the new buyer. Also, what is your financial? I don't know if you had a phantom stock plan or something with clear expectations, but like the amount of moral integrity you probably had to have in that situation is probably interesting.
It was a tough spot. The founder, him and I, we've become good friends. He was great through the whole thing. He supported me through the whole thing and worked with me through it. So we always had that. We had complete trust. We'd been working together for that time for 17 years. We'd been through a lot growing the business. He's an awesome guy, still a good friend of mine. So we had that complete trust to work through on that. So that part worked good. It didn't work as well on the other side, where I got beat up a little bit. But on that, and kind of pushed into some tough spots. But again, it was all learning. It was all learning and figuring it out. And
So then after you went through that experience and you're going through the more intentional of like, hey, we're going to take this to market, was there anything that you learned? I mean, double digit growth, and I want to hear more about how you guys were accomplishing that, but like, what did you have any kind of epiphanies of what was valued in the marketplace with what you were doing, and how did your first experience change how you approach the second time around?
I think the first experience, it really helped us just illuminate we're now ready, right? I think that's part of it. It's just your mindset. Like, are you all in? I'm not sure we're completely ready the first time, but after going through it and regrouping, said it's time. It's time. They're ready to exit. It had grown larger than they had ever anticipated. They were going to do well. We were ready to invest and grow stronger and have that capital to come in. We knew we had a big market. I think what we learned that the banker helped paint a picture of is the size of our market opportunity, how we positioned against competitors and other things, and then how we really, this helped too, how we got really clear on our strategy for the future, our plan, and our financial projections, which is a big part of that, which I love to run financial projections. I always like to be like, what do we need to be doing today to get where we want to be 3 and 5 years from now? So I think all of that was really helpful. And then when we went through the process, the kind of formal process, I think the biggest thing there too was we just said, I had kind of misunderstood private equity. I thought they came in, took over, told everybody what to do and directed you. And I'd seen some other people do that. And that's what it seemed like to me from the outside. What I really realized is the right private equity partner will buy into your vision and strategy. They may have thoughts and opinions or ideas, but the right ones won't force anything on you. They'll buy into what you're doing, then just work with the team to enhance it and help develop it. And so we put together our strategy and we went through the process. And I remember we did a practice run before our first management presentations, my executive team and I, and we were trying to rehearse everything and what we were going to say. And it was a brutal practice session. It was bad. And I remember leaving that night just going, man, we have one of these tomorrow. I'm not sure how this is going to go. I even called the founder on the way in because he wasn't really part of the process. Again, he let us run it. And I just kind of told him what had happened and kind of where we're at. He just, he was great. He just said, look, you guys know the business, you know your plan, go share your story. The right firm will buy into it, understand it, and they'll love you guys like I have. And do that. And if they don't, or if it's not their cup of tea, that's okay. It's not bad, better to know, but don't try to be right. Just go tell the story and see who it resonates with. So I came in, called a quick huddle with my team and shared that information, said, let's just go have fun today. Like we always do, tell the business and, see where this takes us. And that's what we did. And through the process, a great firm really rose to the top, and they are fantastic partners of ours for 4 years. And they didn't operate. They didn't tell us what to do, but they're super smart and they asked great questions and they threw out great ideas. And together we figured out some, enhanced strategies to help us grow. And it was a lot of fun. And I still stay connected with them. They're great. They're great people.
So what I would love some clarification on, Ron, is how you guys and your team had that vision that you talked about, and then your options. So there's this concept that I've been trying to hammer through to people on the show that if you got the right value and understand the value of your company and you really understand your vision, you can go marry those two up, but you're going to have multiple offers that might have different opinions of what they want with your vision, but have the right financial offer, right? So you're trying to take your vision and the financials and weigh both of those things against your offers, where most times you have people just running after that dollar amount, having no idea that their visions are completely out of whack with the PE firm or the buyer, or they might have different intentions. Like you just said, you just didn't understand what those intentions were because you didn't think to ask because you're only focused on the numbers. So you have to be so focused on both to essentially go get married to another partner. So I'm kind of curious, walk us through some examples of how you experienced that.
Well, I think for us, it was really important who our next partner was going to be. And so we created a little grid ourselves and how we were going to grade the private equity groups that came in to meet with us. And it was things around market knowledge, culture fit, buy into the business. We had about 8 categories. And after every meeting, we'd come back and grade them independently, send them to my CFO, and he would calculate them all. And we kept a running tab because you start meeting with so many that you kind of lose track. And so we did that. And one advice I would always give people, which is pay attention to the questions that they ask. That to us was sort of a clarifier whether they really got our business or really bought into our vision or not. If they were asking questions that were sort of aligned or adjacent, that enhanced things, that showed they understood where we were going and were asking good questions on how we've gotten to where we're at and how we would get where we're going, that was a good indicator to us. Some of the firms didn't ask very good questions, or would make flippant comments on something. I remember one was they heard of our great customer service scores, and without thinking or even putting a thought, they're like, well, you should raise prices. I was just like, yeah, maybe, I didn't react to anything. I was like, okay, raise prices.
Yeah.
Maybe, but not that flippant, not like that. You start to get that vibe of who's really going to partner with you and who just sees it as some thing they're going to own. And taking in a direction that they want to go. So I think for both of our processes, that was really key for us.
So you gave a good example of what is a bad question. What was maybe some questions, or maybe more the answer or how they responded, where you were like, okay, those people really truly get us?
Yeah, I think culture is big for us. That's our number one core value is our culture and differentiator for us. And so I think people who took the time to really dive in and understand our culture and the people and how we do it and how it's important and why and how it's led to results, versus yeah, let's get to let's get to all the financials. There's a difference there between people who spend time wanting to know about the people and the culture and thinking about how not to disrupt that going forward, backed up by reference calls and checks with all of their firms to make sure they've demonstrated they know that, versus people that pay lip service to it or have a really bad view, in my opinion, on what culture is. And so I think seeing alignment through there was really key.
The offer that you got from the buyer, did you like, and I don't know if there's any like, because I'm viewing like how you're weighing these offers, right? Because you've got the buyer, their intentions and the alignment of the vision, you've got the enterprise value, and then you've got deal structures. Every one of those are different.
Yeah, for us, they all lined up though. And I think the point being is that the firm that really buys into all that you're about and all that you do, those should all pretty well line up, because the ones who didn't quite get it or didn't quite buy in, their offer reflected that, or deal structure reflected that. The one who was super excited about, not the one, we had multiple, but the one we selected was super excited about it, knew the industry, knew us, and so they put together a great offer. It's not a fight and a tug, and it's not hard when it fits and it's good and they're fair, and you go through that. And then questions that you have as you're walking through structure and compensation and other things, I remember talking to them about it, and they were just really good and reasonable and calm and thoughtful. And here's how we think. How do you think? What would work for you? And oh, we could do that. And like, we want to make sure the team's aligned. And they were really thoughtful. I remember coming back to my team and going, man, if this is how they work through issues, like this is good. I can talk through anything with them. And there was no judgment or, like again, the firm, the one that went bad, anytime I had a question around stuff like that, it was just like a fight, and it was judgment and like, oh, that's not how you do it, and like, it was completely night and day. So I'm really glad I had that one experience, because then it showed me what a really good experience would look like. So bottom line is, I really do believe that those things, it doesn't always happen, but with the right fit, they should line up pretty well. It doesn't mean you don't negotiate at all, but they came and it just made everything fit, and it was obvious and it was clear. And
I think focus on having a valuable business that you can walk away with and you're having fun allows you to take the time to select the right people. Too many times, people just have their head down, waking up, they need to because they're burnt out, they're out of cash or whatever happens. And then they just have one option or something like that and don't understand how to align all the stuff that you're talking about.
we were working from a position of strength because we didn't have to sell it, and we were running a good business. And if at the end of the day it didn't work out, we'd keep going for a couple of years, but it all came together. And I would just say, kind of jumping ahead, 4 years later, we went from one private equity group to the other. Very similar process, very similar structure. We made our chart to grade everybody, and the firm we selected, they just lined up on all the key elements, and then all their reference checks were all spoke very high of them. And I asked for all of them. It wasn't like, don't give me three, give me everybody. And I had multiple, I'd call, my CFO would call, a head of sales would call, and we would check them out, and it just all came back very, very positive. And so we've been and they've been a great partner. We've been with them about 14 months, and they've been fantastic. So as bad as the first experience was, the next two that I actually did have been just phenomenal.
Well, it's super interesting, Ryan, because one strategy that I love for people is to have, if you're growing value with a couple different options in mind, you don't have to commit to anything, but you're going towards a valuation. And I say, yeah, if you're under time constraints, private equity might be bad because you're trying to essentially find your soulmate in a couple dates, versus taking the time, but you can align everything that you've discussed with the perfect private equity firm to fuel the capital and the growth. But if you can't find that perfect fit, if you turn around and did an ESOP at the right valuation, something it's option for keeping it, but you have to spend the time to find that alignment versus just focusing only on the dollar amount.
That's exactly right. I think it's, what are your goals? What's the best fit for you? What are you trying to accomplish? So is an ESOP better? Is private equity better? Is a strategic buyer better? we had made the decision, hey, we're not going to invite strategics in. We want to own it. We're the platform company. We want somebody to fund it, to invest in us, and we want to accelerate it. And here's our plan. And we just wanted some kind of capital dollars in there to do that. And so private equity was best for us. But I think asking all those questions, and whoever all the partners are, all the players, I think getting alignment. I think we had alignment through the executive team, through the founder, his partner. We were all on the same page what we were looking for. And the founder said, he's like, don't worry about the valuation. It will be there. He never said it has to be the top whatever. Let's just play it out. And we all agreed the right firm that should come, right? And it'll all come together.
So then after you guys had closed the deal, and feel free to get in the weeds on this too, because we've covered a lot of technical stuff in my show that like on the deal structure. So you and your other executives who are going to be, private equity backs management. How many times we've heard that? How did you guys, so if someone's listening and they've got executives that are like in your position who they want to help move to the next stage with a PE firm or something like that, or someone that's listening in is in that position, how did you guys structure where you got more equity upside in the next deal? I don't know whatever details you want for you and your management to get to participate in that next round. And then what did you guys do to fuel growth? Like what was the plan to utilize that new partnership?
Yeah, so we came with a projected growth based on our historical performance. And for us at the time back in 2015, it was an expansion model of opening new offices, going from 2 offices a year to 4. And it's some investments on some lead generation strategies. And so we said, here's our regular projections based on historical, but if you took those numbers and then accelerate them 2 offices to 4 and lead generation from where it's at to double or whatever, here's what the model should show you. So we had an accelerated model. And so they got excited about that, right? Because they said they want to, we're also looking for private equity companies that were investing in growth companies, right? So you also have those niches. Some are turnaround, some are, maintain. We were ones that they wanted to grow. We wanted to grow. We were all aligned on that. And so we shared all those projections and got excited and got buy-in on that's the strategy that we will support and back going forward. And so that was part of it, showing that accelerated plan, having an idea. If you show up without a plan, they'll probably help you give you one. Our whole thing was, we have the plan. We want you to buy into this plan, and it may be tweaked or adjusted, but the construct of the plan is there. But if you don't have one, they're going to want you to figure that out, right?
Well, how much easier it is to align your vision with their vision when you actually have a vision that you can describe.
That's exactly it. That's exactly it. But, I just think so many companies and so many sort of smaller ones or up and coming ones don't spend enough time. I would bet that you find that out. They don't spend enough time talking about those things and getting aligned around all of those. And I think that was a strength of ours. We are very aligned and had a vision for the future. And so, they got excited. We're like, yeah, I want to be part of this. So I would always encourage people spend more time there.
Well, what I found also interesting in the first time we chatted is also your vision and your strategies, but your financial acumen of how you went about showing this. Cause you've mentioned double-digit growth and your accelerated growth. I've had people around where they someone either knows it because they experience that growth is expensive, or they just kind of intellectually understand it. But when you're doing double-digit growth, you can grow yourself into bankruptcy. Not understanding how your growth plan is going to cost money and where you need to put that money. Most people don't understand how to tie those two together.
Well, that's another great one that you learn too, right? You go, hey, if we're going to accelerate investment here in years 1 and 2, here's the money invested, but when does that pay off? When does that accelerated come in? And you have to know that and have a projection for that, and then measure against that projection so you know if you're working or not. So many people go, we'll just invest dollars here. I want money for here. And they go what's that going to get you? Well, if it gets you the same results, then that's called an expense. If it gets you accelerated results, that's called an investment, right?
Yeah.
And so that's, again, part of the key of having those financial metrics set up so that you can measure, are we getting a return on this investment or not? And we had a track record for doing this. I think it was really good. This goes back to, again, I think when the founder left the day-to-day business and we ran it, we really had to understand how to run the business for an investor. It was really turned out to be fantastic training ground for how we would run and scale the business and show return on investment. Because now think the difference here, when you're founder owned and you're investing money, you're investing their money, like his money, right? So, I mean, so you better know like what you're going to do with it and when you're going to get it back and in what return, right? I mean, that's what I would want to know. The same thing applies when you invest private equity money. They're set up to like institutional investor, professional, they want to do it. But the same concept applies. You still have to know when are you going to get the return and what is that going to be like? Or you're not going to get as much of an investment as you want. So it's just really fortunate the way we were set up running the business. It kind of just led right into this. Because I remember people when we sold the private equity, people like, oh man, you got to grow now and you got to, you're going to be, I'm like, I've always had to grow. I was hired to grow the business.
Yeah.
I've never not had to grow. I've never not wanted to grow. That's in our DNA. And that's another thing that I encourage you. Maybe you have these conversations with founders that people come to me and talk to me because like the growth guy, you know what I mean? Like, hey, you grow, I want to grow like you. And the first question is like, why? I'm like, what do you mean? I'm like, well, why do you want to grow it? Why don't you just like, if you're at a good sized business, like, why don't you just stay there and just run it and just, have a great life and do that? Growing's hard. And they're like, well, I remember telling this one person like, well, you grew. Why would you even say that? You grew. I'm like, yeah, because that's how I was wired. And that's what I was hired into. And so that's always been my path to grow it. But that doesn't mean it's everybody's path. It doesn't mean everybody should grow. So I just encourage owners to like really be truthful with themselves. Like, what do you really want to do with the business? And I think getting clear on that will help lead you to what are my next steps if I want to exit, or, again, do I want to go with a private equity? Do I want to go with a family office? Do I want to go with a strategic? Where do I want to go? Whatever. Do I want to do an ESOP? What are all the options? But you sort of have to begin with the end in mind, right? The Stephen Covey, begin with the end in mind. What do I want to do, and then kind of work backwards, and that should help shed some light on it. Have you noticed that, or do you get those
Ryan,
kinds of
like you're just stealing stuff right out of all of the same books that I love it.
Yeah, right.
And it's so crazy to me, man. Like I'm literally almost on 5 years in this show, and you got thousands and thousands of downloads on every episode, and you go, okay, why is it so difficult to get business owners to think like this? And Bo Burlingham's been on the show. And we talk about what do you want from your business and why, but like you talk about all these options, and we literally had exit off on all of our marketing years ago. We took it all off. It's like, because people have a visceral reaction to that word. And I think it's because they just don't understand all the options and like value growth. I mean, this is about growing value. What are your experiences talking to people where what do you say to someone when they don't get it? I'm just super curious.
You just got to ask questions. I mean, I think, what I say is just like, you have to get clear on what you want first. The same thing I've said, like, what is you want to grow? What does that mean? Are you all aligned? If you put us all in a different room here with my executive team, they would tell you our BHAG in 2025. They would know. They tell people they interview. They tell new hires. Everybody knows it. Like, I'm clear. We talk about it all the time. So do you have that level of clarity of where you want to be? That's kind of first and foremost, right? And then how are you going to get there? What's the plan?
What do you do when someone's like answering the question vaguely, or you start to realize that they don't know? So like what if I just like blindly just regurgitated a bunch of vanity metrics to you? I wanted to go from 5 million to 10 million, Ron, and I want to go from this many employees to this many. Like, you just keep asking questions, or like
Yeah, well, if you throw out like that, I'd be like, so how are you going to do it? Like 5 to 10 in what time frame? 2 years, 4 years, 5 years? What's the time frame? And then how are you going to do it? Meaning, what do you have to be next? So say it's 5 years. So you want to go to 5 to 10. So what's your revenue going to be at the end of 2021, 22, 23, 24, 20? Do you know it? If you don't know it, you need to figure that out. And then you say, okay, well, it'd have to be this. Okay, that's good. Now, how are you going to do that? So do you have enough salespeople? Do you have enough leads? Do you have enough locations? Whatever your triggers are, do you have those to get there? You probably don't know. So I'm going to ask you all these questions, right? And then go like, okay, so if you don't, what's your plan to hire them? By the way, how much then do they cost? So if I want to go from 2 offices to 4 offices in a year, I knew what that investment was. I knew the cost of an office with the rent, the labor, and everything that we had to do. And I knew when the return was. So I could say it's X amount year over year. And then here's when they start contributing. Like, I would just ask all those questions, and then I start to get deer in the headlights. But I go, these are the things, I'm not trying to overwhelm you, but these are the things that I would encourage you to think about, that we had to think about. So you should be able to work plan and have a year by year plan, because otherwise it's a guess. Otherwise anybody can say, Well, Ron, yeah, double digits. I'm going to grow 20% a year. Good. What's your plan? And what does that mean every single year?
And then how are you going to fund it too, right? And then what's interesting, Ron, I think like the reason I find some of our similarities in how we think is that you got sales and finance, and that's kind of like the two combinations that I have. Where like, and Rob's going to be listening and laughing because I grew up in copier sales, right? 400 phone calls, 15 net new appointments, 5 proposals, 3 closes, 50 grand in revenue, and that's how you do it. But like, so many people don't have a repeatable sales process. And then they go, how are you going to fund that sales process? And you kind of just have to do both of those things. And if you're not forced to do both of those two, then you can kind of fall into that trap of just vaguely chasing these fictitious goals.
Well, yeah. So you go like, okay, because I'm like you. I had the same thing here. 20 meetings a month. We get you 8 proposals. We get you 4 new logos. Average size of a new logo was this. And then the average add-on in the first 12 months was this. Like, so we had all the metrics. And then I go, okay, what do I want my revenue to be next year? If I have the same team, can I get there? No. How many people do I need to add? Oh, you need 3 more salespeople. Okay, good. The next question, what's your turnover? What? You add 3, you think, no, you're going to have 0 turnover? That's what you're planning on? So factor in your turnover. Like, take a hard look, and then you build in this. That's how you get to modeling, though, by doing that. And then you go, okay, if I had 5 Ryans versus 3, and they did that, and I lost a Ryan along the way, but I replaced them. And by the way, their ramp up time, I mean, it gets pretty involved, but we did this all over time too. So like, this can be overwhelming to people. So then you go like, start with this, because that means like, I need to hire 3 more salespeople. Okay, what's their cost? Do you have the margin to do that? Does it take capital to do that? Are you willing to lower EBITDA? You know, you're going to make less money this year by doing that. That will increase your return later, but are you good with that, right? To your point, funding all these things. These are all the conversations. This is called working on the business. And that's where we always spend a lot of time.
And this kind of goes back to your built to sell discussion is like, it's so much more fun to own the business when you're doing this. Like, why wouldn't anybody want it? What do you think? Like, why do people not do the hard work?
Well, I think they're just so busy running the business. I think they're working hard, but they're just in the day to day. It's hard to get your head out of the day to day. I'll go back to Gerber, working in the business versus working on it. And that was a discipline going back. Our founder always did that. He would take out so many hours a week to think about and work on the business. And people just get caught up being busy, and they don't think about this stuff. And then they end up going, I want to exit in 2 years, and they're just sort of lost. I think that's what you probably deal with talking with a lot of people. They got in that mode. They looked up one day and was like, I want to exit. What does that look like? And what does my business look like? We always had an eye towards an exit. Even though it came years later, we always had an eye towards it.
And what I find interesting, if you think about like all the sequence of events that you've discussed, one of the things that absolutely exploded the growth was the hiring of you and the owner stepping back. And it's like literally the bottleneck. Remember The Goal? I don't know if you've ever read the book The Goal. It's like the bottleneck. It's like literally you find this in the manufacturing process, like where's the number one bottleneck? And it's usually the owner. And so like being able to hire someone, any words of wisdom or experience of like compensation plans or motive, how to get that next level, that team, whether it's you or the people like you, that become one of the biggest challenges that owners trying to figure out how to hire that first person.
Yeah. So I think a couple things. One is I'm thinking about, why is it so difficult for people to work on the business? I do think an advantage we had was like, and I freely say it, I never took all the financial risks to start the business or buy it to do that. So I've been a hired manager my whole life. So I've kind of been built to do that. And in some ways, I think that was freeing, that I didn't have to worry about the bills and payroll and all that. It was just figure out how to grow it. So I think I was freed up to think about these things in the business, probably more. As far as hiring the right people, that's a tough one, because I don't think there was a grand plan when he hired me to think I was the guy that was going to do this. I mean, we laugh now. I just talked with him and we laugh now. Like, we never dreamed we would be the size we are now doing all these things. Like, it's exceeded everything that we thought. But yet, as we achieve more, we see the opportunity to do more. So to boil it down, I think what he was really good at, and he taught me, was he shared a lot of information in the business, the financials, and just the strategy and the market opportunity. He wanted us all to think like business owners. It doesn't mean we're all tied in with performance-based comp or equity or anything like that. It was just, he shared it because I think he had an experience early in his career where people didn't share it. So you feel like you're flying blind. And so I think he always employed me like, share it all with the team and you'll be surprised and amazed at the ideas that will come back and they'll help you and they'll figure it out. You can't take it all on yourself. And he was really, really good with that. And I think by doing that, he built up a team that understood the business and could take it from him at the right time and grow it. If he wouldn't have shared all that with us, we never would have been in a position where we could have taken it and ran with it like we did. And I say we, like me, it wasn't just me. It was, I got the position, but it was my executive team and the leaders that we had that all came together to do this. It really took everybody to do it.
And it's interesting because like you experience what it was like having a kind of a passive investor. So when you're looking for the PE firms that you want to partner with, you have an idea of what it is that you want and what it is you don't want. And I'm curious, like, was there any different styles of how the first and the second PE firm were motivating you and your employees or your executives that were slightly different, or did you kind of have a lot of the similarities from owner to owner?
Yeah, a lot of similarities. The biggest thing that we were very clear was we didn't want an operating partner. I don't want you in here showing me and running the business or sending people on site to be here a bunch. We were very clear on that. And we had a great track record where they both bought into it. They both said, that's not what we do. We're not operators. We're investors. They both have said, if we're operating, we're in a little bit of trouble. Like, we're not operators. And again, looking at their track record, that's not what they do. Now, if you need resources or need connections, whatever, they both were great at providing those. But that was the biggest thing was, hey, we can do this. We just needed the financial boost to get where we want to go. And again, here's the plan, here's the strategy, here's the investment, here's the return. And they go, okay, it's not quite that easy, but they get it, ask a lot of questions, but then they go, okay, now let's measure against that. And are we getting it? And in our first turn, we did great with it. And the second one, we're off to a fantastic start. So
what was it like selling a company from one private equity firm to the other?
Yeah, it was kind of similar actually, because the private equity group really stayed out of the process. We ran through it. It was actually a little bit easier because we'd grown to a size and our market had to enough where it was known. And the first time we were really educating a lot of buyers about it. So people were trying to figure it out we were trying to figure out who really understood. The second time around, people kind of knew what it was. And so it wasn't as broad of a process, a little bit more narrow, but it was very similar process and experience. And again, I think the process led us to a great partner for us at this period of time in our growth.
You had to probably really truly understood that, like, that first private equity firm really did believe what you believe, because they could have probably chosen certain financial outcomes above and beyond your guys' big vision for the company, because that's really, at the end of the day, for a PE firm, that's what they get rated on, is their internal rate of return. So like, did you see any circumstances where they could have led one direction and used their muscle to push you in one direction versus the other if they were not the right partner?
It's hard to say. I mean, for us, we did some acquisitions and we still do some, but we don't do like a big roll up amount of acquisitions by everybody. So I think if they weren't the right partner for us, they could be really forcing and putting pressure on doing more acquisitions or buying companies that we did not think were the best fit. Again, I've been very fortunate. I picked right, both of them. The one that I was with 4 years and one I'm with now, anytime that we said one wasn't a good fit for us, they wholeheartedly agreed and absolutely zero pressure. If they're the right fit, that should line up pretty good. And private equity gets a bit of a bad name, and there's some firms out there that deserve it. I'm sure, but I tell you that the one my experience now has been phenomenal. They've been great partners, but we spent a lot of time making sure we're aligned and very clear around the strategy and the return and the opportunity. And so I think that's I kind of keep coming back to that, being very clear. If you're not, they'll help you. And then you go like, maybe it won't be the way you want to go, but how do they know if you don't tell them, right? We've been very clear about the direction we wanted to go and how we would do that and what the end goals were. And, the first one was a home run, and we're, knock on wood, we're on our way here in the second one.
So I got a couple of follow-up questions, and then we'll wrap up. Okay, so you're 240 million now. What is, like, you keep pushing out that goalpost? What's the BHAG now?
500 million, 2025.
Okay, I was going to say, I'm assuming I'm going to get a very clear answer about that.
Yeah, everybody knows it. We talk about it a lot.
Combination of organic and acquisition, or what's the main strategies?
Yeah, double-digit organic growth every year, and then disciplined mergers and acquisitions. And so I use the term disciplined to just, again, to convey, it's not a roll up. It's not just buy companies for the sake of buying them. It is only buy the ones we think are great fits for us. Great culture fit, meaning they know how to take great care of their employees. Employees work together really well, and they're passionate about taking great care of their customers. Those are two things that if you don't have, I can't give you. It's interesting. I just saw a Gary Vaynerchuk. Do you follow him at
Yeah,
all?
yeah.
Yeah, everybody knows Gary V. And he showed an old interview recently with Jack Welch, who's the former CEO of GE. And he talked about, I just saw this on Instagram a couple of days ago, but Jack Welch said the one thing he would put more emphasis on early in his career would be like, you've got to get the culture fit right. Don't get so caught up in the numbers. If the culture fit's not there, don't do it. And my leadership team, we've been kind of sharing that because we talk about that a lot. And so I think that's why we have to be so disciplined. And then when we like somebody, like the one we just did, we go after it pretty aggressively, and do that. So those are the things: double-digit organic growth, M&A, disciplined M&A, and I got the projections out to where we're going to go, and then we'll set a new BHAG as we hit that one.
And we do not have time, but I just kind of curious if there is a somewhat short of an answer on it. Is the double-digit organic growth? So like, you guys aren't in a service-based business where you can just put the throttle down on Facebook ads and triple your revenue. I mean, you're in a normal B2B kind of business services. So like, what is some of the, couple of takeaways or secrets behind that, maintaining that double-digit growth?
Yeah, I think it's staff, right? So it's how many salespeople do you have? I talked about it earlier. How much do they sell on average? So how much do you need? Then it's funneling in the pipeline. We're really spending a lot of time on measuring and understand our pipeline. What size is that? What percentage do we close every month? So what if we're going to do this? How many leads do we need in there? How many meetings? How many leads generate from our demand gen team to build the pipeline a certain size? We'll close a certain percentage every month, and we go. The pipeline's not there. Now we're asking salespeople to close something out of nothing. Like, that's not it. And so it's really just an extension now from just pure headcount to pipeline build, and more from location build out, because we're pretty much built out throughout the US, to market penetration, how we're going to get into there. So again, the story evolves, but it's the same concept. Know your metrics, know what they are, know what they need to be, and look at what are we on pace for every single year and make adjustments as necessary.
I love it because it's not some silver bullet. You know what I mean? It's like, hey, you did. It's all the activity, man, and close ratios.
Yeah. I mean, it really comes down to that, especially for a services like us, and phenomenal customer experiences, so that you're not losing customers. You deliver and you over deliver on any promise because you're working so hard to get them. You do not mess that up once you get them.
So, question for you, two more, and then we're wrapping up. What does intentional mean to you?
Intentional means knowing exactly what you want to do and then going after it. And so, like, nothing on accident, right? Don't just, oh, I hope this happens again. Here's a big number. I hope we hit it, but I have no idea how. I'm going to be very intentional about our strategies and what they are. And if you make mistakes, and you will, you're intentional, then you correct them, because you know what you're trying to do and you measure against it. So everything for us and everything in my life, I feel like, is intentional. Like, if you're a dad, are you intentionally trying to be a good dad? Doesn't mean you're going to be a perfect dad. Doesn't mean you're not going to make mistakes, but there's an intentionality around, I want to be involved and raise my kids a certain way, not just have them, let them grow up and hope it turned out okay, right? So, I mean, I don't know if that's a good analogy.
I love it. I love it. It's just yeah. Bo Burlingham, right? What do you want and why?
Yeah. It really a lot of it comes down to that. You see it, like, it's so many people have trouble answering it, and that's okay. But if you want to do it, you need to go back and answer those questions. Bo's awesome, by the way.
The last question is, where does everybody get in touch with you or follow you as they want to watch you hit that 500 million?
Oh, thanks. Yeah. So company website, serviceexpress.com. We're on Facebook. We're on Instagram. We're on Twitter. And then I actually have a page, alvesteffer.com. I've got a weekly video blog that I put out on leadership and organizational development, where I just share thoughts and stories around what's going on here. And so now I'm also on Instagram and Facebook as well. So you can find us. And with a quick Google search, because we invest in those searches, we should both pop up right away.
Ron, this has been an absolute blast. Thanks so much for coming on the show.
Yeah, thanks for having me, Ryan. I enjoyed the conversation, as I knew I would the first time that we talked. So appreciate it.